Hi and welcome to Swissquote's daily market talk. It's Tuesday, August 5th. Equity markets rebounded yesterday on the back of strong dip buying from investors that expect the Fed cuts to continue supporting stock valuations. The US dollar and oil, on the other hand, are weaker, while the ounce of gold consolidates a touch below the $3,400 resistance. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week kicked off on a positive note as investors rushed to buy the dips from last week's correction, while sentiment in European stocks remain kind of contained due to tariffs and the implication of tariffs and strong euro. There are now two distinct opinion camps regarding whether the major US indices should return to fresh all-time high levels or there should be a further downside correction following last week's downside correction. So the bullish camp actually defends the fact that earnings in the US have been stronger than expected and that the rising rate cut prospects from the Federal Reserve are sufficient to send major US indices to fresh record high levels, and optimism could also somehow echo across the global financial markets, although the tariff implications there are kind of heavier than for the US for the moment. Then the bearish camp hears these arguments but highlights that the strong US earnings were partly due to a softer US dollar, that the technology companies of the US eked out a nice 26% increase to their profits, but the rest of the index actually printed a profit growth of 4% only, and that the rate cuts from the Fed are not necessarily justified even with the deteriorating economic outlook for the US economy when inflation remains hot and also at risk of further rising, as some companies in the US and some foreign companies as well announced that they will be passing a part of tariff costs on to their clients. Now, what's pretty clear right now is that retail investors seem to be, still running the bull show as the CFTC data continues to show strong net negative positioning among institutional and speculative traders. And that's understandable, mind you, because traditional investors don't necessarily like uncertainty in the markets, and there is nothing more certain right now than political uncertainty, than monetary policy uncertainty, than geopolitical uncertainty, and also trade uncertainty on the horizon. But hey, the Federal Reserve has actually been very much capable of fighting any market weakness, any market sell-off in the past with its juicy policies, and Donald Trump will actually make sure to form a monetary policy committee that actually reflects his vision of the perfect central bank policy, one that actually cuts interest rates. Now, speaking of that, the Fed is expected to cut its interest rates twice before the end of this year, with the first rate cut now broadly priced in for the September meeting. Activity on Fed funds futures now gives more than 90% chance for a September rate cut from the Fed versus less than 40% chance given last week just before the dramatic US jobs data landed on the runway and actually resulted in the firing of the BLS chief, remember. So investors will be watching the ISM and PMI data today. A set of softer than expected figures from the US could eventually further fuel the dovish Fed expectations and support the equity valuations, and that despite rising price pressures somehow. If the price pressures are lower, that's going to be even better, while a set of stronger than expected data will certainly do little to reverse the September rate cut expectations for the Fed. On the contrary, any bright spot that we might see in the data would further support the idea that the US economy is holding up well despite the tariffs, and the Fed will have to cut anyways because Donald Trump wants it to cut rates. What I'm trying to say here is that we are in kind of a blind spot where investors are capable of seeing the glass half full, whatever the data suggests. And even though the equity rally barely matches the global headlines, the rally is certainly on, because the S&P 500 printed its best day since May on Monday. Futures are in the positive at the time I'm talking here this morning, both for Europe and US equities, with Nasdaq futures in the US leading gains after Palantir announced better than expected second quarter results yesterday, after the bell, sending the share price of the company some 4.5% higher in the after hours trading. AMD, on the other hand, is due to report its own earnings after today's closing bell and is also expected to announce strong quarterly numbers on strong AI demand, obviously. So let's see if strong numbers from AMD could, well, help the company extend its recent gains. Now, note that despite robust quarterly results, some leading chip makers, including ARM Holdings, for example, and Qualcomm, will actually fail to bring investors on board after the announcements. The chip industry, on the other hand, is expected to become $1 trillion industry by 2030, so demand is there, but the question is, what percentage of it is already priced in? For AMD, while earnings announcements will be a test relief for investors, the company has actually been the best performing chip stock of 2025. Did you know that? And well, beating expectations alone may not be enough to push prices higher. Investors will be requiring a strong outlook as well. So let's see what happens. But in the bonds market, calm reigns before the US 3, 10, and 30-year bond auctions due this week. Here as well, investors around the world seem to have digested quite well the explosive US debt news of a few weeks ago. So the US 10-year yield is down to 4.20% this morning. And beyond the US bond markets, the Japanese 10-year yield has also eased below the 1.5% level this week, and a gauge of European 10-year debt yield fell to a 2-week low as well. So even though the long-term outlook remains positive for DM yields on the back of rising debt worries in these locations, investors don't seem to be much disturbed by rising yields in the short run. In the FX markets, while the US dollar consolidates its losses following a sharp post-NFP sell-off of Friday, the outlook here, which had turned slightly positive since the beginning of June due to crowded short positions in the US dollar, is now turning neutral again as trade tensions, the weak economic data from the United States, and rising dovish Fed expectations are actually supportive of the bears for the US dollar. As such, the euro dollar tests the 50-day moving average to the upside, and strong PMI data from Europe this morning could eventually help clearing this resistance. Cable, on the other hand, rebounded from a critical Fibonacci support last week, and the pair remains in the bullish consolidation zone as a 25 basis point rate cut from the Bank of England expected later this week is already mostly priced in the market prices. Hence, the sudden rise that we see in the dovish Fed pricing is weighing heavier on sentiment right now than the dovish Bank of England expectations. Plus note that Brits actually face rising inflation in the coming months, which could, well, eventually result in a cautious rate cut from the Bank of England this Thursday. So if that's the case, well, cable could well remain in the medium-term bullish consolidation zone above the 131.40 mark, which is the major 38.2% Fibonacci retracement on the year-to-date rally. In the energy space, crude oil extends losses on OPEC's latest decision to increase production by 547,000 barrels per day from next month, totally exiting the output restriction policy, fueling the expectation of a surplus in the second half of the year. Here, critical support is seen near the $65.20, $65.30 per barrel area that shelters the 100-day moving average and the major 38.2% Fibonacci retracement on the year-to-date decline. Now, a sufficiently soft US dollar could eventually help keeping oil prices in the bullish consolidation zone, and elsewhere in commodities, the weaker US dollar and lower yields turn positive of gold prices amid ongoing trade and geopolitical uncertainty. So while strong resistance is seen into the $3,400 per ounce level, the outlook for the precious metal remains comfortably positive, and a further rise in prices toward the $3,500 per ounce psychological level looks increasingly plausible. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.